Those people that think that maybe we're in a recession right now, when the revisions come in on GDP, will have been proven correct.
In this thought-provoking video, David Rosenberg delves into the intriguing paradox of economic data, unraveling the hidden truth behind GDP and GDI's disparity. By dissecting historical patterns and critical indicators, we explore the real state of the economy amidst a roaring stock market. Brace yourself for an insightful journey as we challenge conventional wisdom and reveal the essential signals shaping our economic landscape.
And in fact, it's running negative 0.8% year over year at a time when real GDP is plus 1.8% year over year. So we have this dichotomy going on between the national accounts. GDI represents the income accounts. GDP is GDP. It's all about spending. So there's a gap here between the income side and the spending side. Now, look, if you go back to last year, there was this period where we had successive declines in real GDP. And all the pundits out there were saying, well, ignore the back-to-back declines in real GDP because GDI is still positive. And what they were saying is, just wait, GDP will end up gravitating to where GDI is. And they were right. What's interesting is that we have positive GDP, but we have negative GDI, and nobody says a word about it. You see, they sort of swept that under the rug because it doesn't fit the bullish narrative. But what we have to know historically is that when we have real GDI negative year on year and back-to-back quarters of decline, that has been a recession signal back to 1948 only 100% of the time. And what you find historically is that it is GDP. For all the people that think that we're in a soft landing, well, look at the spending numbers. Remember that the spending numbers have a lot of imputations on the service sector side. We are a service sector economy. A lot of the spending, especially as it pertains to real estate, but also other services, are imputed by the government statisticians. The thing about gross domestic income is that there are no such imputations. So what people are going to find that they'll be surprised, and this is what's happened in the past when you get these divergences, and this is a whopper of a divergence, but we know that over time, the national accounts have to balance. What we also know is that GDP ends up following in the tracks of GDI. So that's why it's important right now to focus on the divergence, because what people don't realize today as they look at this false glow of the economy from a spending perspective, not being ratified by the income data, is that the spending numbers, the GDP follows GDI, not the other way around. So for those people that think that maybe we're in a recession right now, I understand that the stock market doesn't see it, but the stock market stopped being an economic indicator a long time ago. It's a momentum index right now. The people that are saying that we may have already entered into a recession, when the revisions come in on GDP, will have been proven correct. And I'll just do another reminder. Nobody thought that the recession started in December of 2007. December 2007 was when the Great Recession began. And most people didn't even realize it because they weren't focused on income, they were focused on spending. Most people didn't start to forecast a recession until Fannie and Freddie went into conservatorship in the summer of 08. The recession was already 6-7 months old. That came as quite a surprise, but not to the NBER, because they're always late because they're very methodical. And they dated the recession back to December 07, when everybody and their uncle or aunt were calling for a soft landing. Go figure that one. And then you go back, I can go back cycle after cycle. The recession began in March of 01. The tech wreck recession. Who was calling for that? Nobody. Most people calling for recession, do you know when? After 9/11. The consensus moved to a recession call and out of a soft landing call in September of 2001. The recession had started in March of 01. So this is what I mean about recessions, is that they're like an odorless gas, you know. It's like it sneaks up on you when you don't expect it, and it usually happens just as when the feverish pitch from the consensus is that we're in a soft landing, which is exactly where we're in right now. But keep in mind that GDI is what doesn't suffer the same statistical impurities that GDP does. That's why it's important. The labor market is a lagging indicator, okay? And you have a central bank that's focused on contemporaneous and lagging indicators. All right. Unemployment rate and your labor costs are in the index of lagging indicators. David Hay talked about the Conference Board's leading economic indicator. It's down 14 months in a row and has provided, once again, 100% recession signal. And guess what? The stock market is one of the components. You want to know what the labor market, labor costs, unemployment rate in the index of lagging indicators, non-farm payrolls, which everybody worships, the first Friday of every month, is in the index of coincident indicators. What are the two labor market components in the index of leading indicators? And there's only two. Is the work week, which has been contracting, and pretty well at the same level today it was back in April 2020 when most of the country was locked down. The work week is a leading indicator because hours lead bodies, and although companies have been like the boy with a little finger in the dike and trying their best to hoard labor, they've been cutting their hours. But hours worked are a leading indicator for anybody that likes to drive looking through the front window instead of the rear view or the side view mirror, all right? And initial jobless claims are the other leading indicator, and they have been hooking up irregularly for the better part of the past 6 months. So I think that we're going to be seeing some cracks in the labor market, but they usually happen after the recession starts. That's my view on the labor market. David Hay accurately said that we're in a profits recession. When profits go down, when corporate income goes down, companies respond by preserving their margins by cutting their costs, and the biggest costs are labor. So my view is that the labor market is going to be shifting into a disinflationary development and will be one of the factors that underpins the recession. But more often than not, employment only starts to go down if the recession starts. The unemployment rate only starts to go up once the recession starts. So we're really predicting here what a lagging indicator is going to respond to from everything else that's happening with the economy. The labor market is always the last man standing. I know that everybody's always interested in the labor market, but it's a lagging indicator. And in terms of the comment before about the stock market, can it go back to the highs? Maybe it can. We have a 19 plus multiple on the S&P 500. So you're talking about an earnings yield that is inferior to the yield that you get on the risk-free rate. So investors are chasing the market. This is a momentum and momentum-driven markets, right? When investors start to pile in because they're bowing down to the holy grail of price momentum, you get a melt-up. And it's not based on fundamentals. It's based on speculation, momentum, technicals. That's what's driving the market right now, and sentiment. But make no mistake, the market multiple, it's not a great timing tool, but think about as an investor what you're paying for. You're paying for an earnings stream. And you're paying for an earnings stream taking on capital risk, which is why you should always be mindful of the equity risk premium, which has been ground back down to well under 100 basis points. So it's a very expensive market, straight up and benchmarked against risk-free rates. And the stock market to me reminds me of the clown at the circus blowing up the balloon and blowing up the balloon and blowing up the balloon until the balloon will finally just pop in its face. I heard on CNBC today commentators saying several times, I think it was on Squawk Box, that FOMO is here to stay. Did you hear that? FOMO is here to stay. It reminds me of Irving Fisher in 1929 saying, and he was an astute investor, that we are at a permanently new plateau on equity market valuation. How well did that turn out? FOMO was here. Do you see what I'm saying here? You're asking us about the stock market that's being driven. It's breathing fumes of momentum. So, of course, it can go to new highs. Is it rational? No. Can it happen? Yes. Will it be sustainable? Well, I've never actually seen the stock market rally through a recession. Maybe in the second half of the recession, normally the stock market bottoms, the real bottom is 70% of the way into the recession. This recession hasn't even started yet. And by the way, even if you have a soft landing view, like the 68% of fund managers, the market is still stupid expensive. So I believe in buying low, selling high. Right now, we are basically almost back to peak multiples in the context of an earnings recession. And the Fed is not relenting. So you can't even say that, oh, well, I'm going to rally the stock market because the Fed's going to cut rates. They're not giving you that indication one bit. So it's really a speculative market right now. And if you want to play the momentum, may the force be with you. But what we find in the past is that rallies that are not backed by fundamentals are rallies you can rent for several months. They're not rallies you can own.